Hi, and welcome to Money Control's post budget show. This budget seems to have ticked all boxes: healthcare spending, capital expenditure spending, asset creation, asset monetization, increasing FDI, creating a bad bank. It has ticked all boxes, and the market seems to have welcomed it as well. To discuss more, we have with us a panel of experts. Our first guest is Mr. Arvind Chari, who is Chief Investment Officer with Quantum Asset Managers. Then we have Mr. Gaurav Kapoor, who is Chief Economist at IndusInd Bank. And then, of course, our very own Manas Chakravarti, Group Consulting Editor at Moneycontrol. Welcome to the show, gentlemen.
Thanks, Ravi.
Arvind, let me kick off the show with you. So the equity market seems to have embraced this budget wholeheartedly. I mean, the Sensex is up around 3.5%, but I think debt markets have not taken to it very kindly.
Yes, you're right, Ravi. The increase in fiscal deficit. Hello, can you hear me?
Yes, Arvind, we can hear you. Please carry on.
Yeah, I was just getting a feedback. Yeah, I think the increase in fiscal deficit was way more than what was expected. Some of that will be accounted by the change in the government trying to get off-balance sheet items like spending on food subsidy onto on-balance sheet. But if you still see the overall expenditure numbers that they've put up, way higher than what the markets were anticipating, and especially the way the government behaved in FY21, fair lot of fiscal restraint, not spending when people were asking them to spend. But as they've been kept on saying that they will time the stimulus, will time the spending, and I think they've used that significantly in FY22. They've also going to spend higher in FY21 itself. The bigger worry for the bond market from a longer term perspective will be the fiscal consolidation path that they have laid down. India has always targeted that 3% to GDP, which was always very ambitious, not very difficult to reach. But now they have calibrated that upwards to 4.5% by FY25. That's like 4 years out. That is a significant increase. That should give a lot of growth impulse headroom for the government, and that's why the equity markets will also kind of get that bullishness. But for the bond market, this is a problem. This means that very high amount of government bond supply, and likely to remain for the next 3-4 years. So, you can very well clearly say that bond yields have well and truly bottomed out. Whatever lows we saw 1 month back, that those will be the lows will stay, and then I think yields will keep going up. The RBI's response has to be seen, and I can take that question later. How RBI responds to this kind of budget? Do they see it inflationary? Do they talk about that consolidation being so much delayed? Those things need to be seen. But from a bond market perspective, bond yields and market interest rates are well and truly moving up.
Yeah, Gaurav, first thought.
Ravi, I think I would say it is along the expected lines. The budget actually just focuses on spending, and if you even the finance minister's speech was largely focused on spending. Yes, in fact, spending by the government will turbocharge the economy not only in the coming year but in this year itself. Because if you go by the government spending till November, for which data is available, the government had spent some 19 lakh crores. Now, in the next 5 months, the budget spending goes up to 34.5 lakh crores, which is 17.7% of GDP. Means almost a spending of about 3.2 lakh crores every quarter. Now, of course, some part of it is because the NSSF, funding of the food subsidy through NSSF has been brought on budget, which is getting reflected in higher fiscal deficit numbers, and procurement has been recorded this year. The finance minister pointed out that herself. Even in the going next year, at 15.6% of GDP, the size of the budget, I think, is as big as it was post, I think, so last year at 17.7, it was the highest, I think, since the global financial crisis. This year, it's pretty much at 16% roughly. is so focus is on spending. Within spending, the focus is on pushing health, and ultimately the biggest fiscal stimulus the government can provide the economy is to get the vaccine out there, widespread vaccination, inoculation, for which I think at this point in time the numbers seem reasonable. Overall, healthcare spending has been increased by more than 100%. Asset monetization, as you pointed out, has been something we talked about. Formation of a bad bank has been discussed at various stages in previous years. In fact, former Governor Ravi Patel wrote an article in FT yesterday where he ends by saying that you need to unclog the financial system. So it is a welcome step, but again, the design of the bank will be remains to be seen. Pricing and all those issues need to be sorted out. Asset monetization, aggressive pipeline, disinvestment more reasonable, but LIC IPO finally comes in. On tax side, thankfully, no major, no new taxes. So if you take into account that both taxes and non-tax revenue this year, my estimate is around 9% of GDP. That's where you, in the coming year, I mean, and that's where you end at 6.8% fiscal deficit. And as Arvind pointed out, humongous borrowings. RBI will have to step in through OMOs, through HTM limit increases, and I think any rate cuts are out of the question now.
Right, Gaurav. So you said that almost what some 40% of spending is going to be compressed in the next 3-4 months. So
Yeah.
will you be revising your GDP estimates for the current year? Do you see
I
a
think
lower
I
contraction?
was yeah. I think I was anyway expecting positive growth in the second half compared to the first half slump of 16%. I think now we probably end up seeing closer to 1% kind of growth, possibly in in the second half of the year versus a minus 0.1%, which the NSSO is estimated. So we were anyways around 0.4, 0.5% average for the second half. I think it will be closer, and it will. Going into the next year, basically you hit the ground running for the next fiscal as well. And as I said, some part of it is food subsidy. So, but then a large part of it is in Capex also. I mean, there's been increase in the Capex budget for this year as well as the next year. So, quality of spending largely, I think, the focus towards Capex has been maintained. So yes, I think growth, we need to look back, reassess growth for this year as well. Perhaps a smaller contraction than 7.7, which NSO has suggested, which we were anyways working at a number around about -7 to -7.5. I think it'll be closer to -7, but I think it provides enough momentum for the next year. And you can already see economic data activity showing GST collections are picking up, both on improvement in compliance as well as pickup in economic activity. PMI data for manufacturing continues to show momentum building up in the manufacturing sector. So these are early positive signs, and I think we will perhaps see positive surprise on growth front.
Yeah. So, Manas, were you surprised by the extent to which the finance minister shared her fiscal conservatism?
Yeah, I was surprised by that, but let me actually tell you what I think about growth. See, there are two ways to look at it. After several years, Nirmala Sitharaman has finally delivered. I think this is a great budget. From the long-term point of view, as you said, it ticks all the right boxes: infrastructure, health, bad bank, FDI, and you're financing that by asset monetization and disinvestment. Of course, your fiscal deficit has also gone up. But look at it from the long-term point of view. What it does is it increases India's potential rate of growth. That is what I think this budget has finally done. And in the short term also, I think we'll be pleasantly surprised by the growth that we are going to see in FY22. Already growth is firing on all cylinders. Look at the corporate results for Q3. They're fantastic. Look at this balance sheet. What Arvind Subramanian said was that India has this twin balance sheet problem, which some people said it's 4 balance sheets, including NBFCs, HFCs, and some guys say it's 5 balance sheets now, including the government. Now, I think a large part of these twin balance sheets, at least the corporate balance sheet, is now in much better shape than it was in 2019. And if corporate balance sheets are in better shape, so will the bank balance sheet. And if growth picks up, which I think it will do this year, then optically at least, your NPA to advances will come down. So I think this is, for the short run as well as the long run, this is a fantastic budget, except that whether will interest rates rise? That is an issue here. Arvind, what are your thoughts on that?
Manas, I agree with you on the growth part. I mean, even ourselves and a lot of other economists had reduced the potential GDP growth, and not because of COVID, but because of the 2-3 years post demonetization, where the structural growth itself kind of was feeling like it was reducing, and we did not see too many growth drivers, investments, public spending. I think the numbers that they've been put up, and more importantly, the timeline to consolidate fiscal. So they got another 3-4 years to keep the fiscal deficit 1.5% above your fiscal consolidation FRBM target. That's a lot of leeway. The GDP grows, so as an absolute amount of impulse spending, that will be very significant. But it will have its cost, right? I mean, you cannot have everything. Much as RBI will try to control, but I think interest rates are headed up. Whether the other worry for the bond markets will also be inflation. Look at the number of custom duties that have been increased, not only in this budget, but over the last 3-4 years. Combine that with commodity price rises that you have seen this year. There are inflationary impulse that are already feeding through, and such amount of increase in expenditure, not only this year but in the next 2-3 years, you would expect inflation to also increase. So RBI, maybe for a very short period of time, now that the GDP or the economy is still not recovered completely, maybe a bit more tolerant with the increase in fiscal deficit, but eventually you would see that interest rates will have to rise. The only aspect to note is whether foreigners come in. What I keep saying, bond with India. India is nowhere in the bond index. Very, very little investments from foreigners in India. Huge scope. Whether they ignore the fiscal consolidation not being followed and look at Indian yields as compared to global yields and pour in money over the next 1 or 2 years. Without that, I think rates are headed up for sure.
See, isn't there a contradiction in the sense that they are trying to push credit growth on one hand, and then by so much by driving up the fiscal deficit so much, interest rates are bound to rise? Gaurav?
Well, Ravi, my point, I think let me take a step back and tell you that I think the stance will remain accommodative for a very simple reason, very simple maths. The size of the economy in March 2021 will be actually 4% smaller than in a situation where you assume there was no COVID, the economy would have been 10% bigger. So effectively, the economy is 15% smaller, which means the potential rate, which itself has come down, as Manas pointed out, and even Arvind said, potential rate of growth is now somewhere around 6.5%. And I'm not entirely certain that the potential rate of growth will accelerate significantly from here on. I think what this does is only basically counters the negative impact, which will show up over a longer period of time. So I think accommodative stance will continue for as long as inflation remains comfortable. Yes, non-core inflationary pressures are rising, but food inflationary pressures are subsiding. So next couple of months, that shift of balance will happen. But yes, I think any more monetary easing clearly out of the way, with globally interest rates moving up, especially in the US. Inflation globally now, is moving up in advanced economies. We were already facing that last year because of supply side concerns, and now with demand picking up, there will be, you will have a kind of further feedback effect on inflation from higher demand. So, and with cost push in increasing on account of higher taxes and now higher custom duties, in general, our average custom duty has increased over the last couple of years, actually, over the last 3-4 years. So on the whole, I think yes, we have basically hit the bottom of interest rates. But that said, till the time credit really takes off in a meaningful manner, banks will continue to park their excess cash with in government bonds. You remember, we still have about 8.5 lakh crores of durable surplus liquidity in the system. Some of it will go out, of course, now with the with CRR hike coming in March, which which is offset, which RBI was an automatic CRR hike which was planned. So I think at this juncture, I would say yes, rates have bottomed out, and a very close monitoring by the RBI would be required. Unlike the first half of last year, I think this year, I would say, I think RBI would be far more active in managing yields, in actually in reducing term premiums, because our term premiums have widened significantly. They widened in other emerging markets as well, but in case of India, the term premium expansion has been quite significant. I cannot recall a time when the difference between the reverse repo rate, which is the actual funding rate, and the 10-year was as wide as it is at the moment, with that kind of liquidity and with monetary accommodation in place.
Right. So changing the subject a little bit. So Manas, there is nothing. I mean, at least what I could see in way of pushing consumption spending overtly. Your thoughts?
Yeah, I was pleasantly surprised by the lack of an overt populist tone in this budget, because there are a lot of elections coming up. So I would have thought that these the usual sops would get much more prominent. I was thinking, if you look at the way the finance minister structured the speech, usually it is all the agriculture and rural comes right up front, and then you slowly come down to the stuff that interests the markets, and the corporates. This time she put infrastructure right up front here, which is actually a great move, because as the Reserve Bank has always said, and everybody else says, that investment demand is what is important for sustainable growth, right? And this budget is giving a huge boost, or is trying to give a huge boost to investment demand. I mean, there's one more thing you should look at, which is that if you look at 2021 or 1920, gross fixed capital formation was actually the highest in several years, So it's not as if investment as a percentage of GDP. So it's not as if investment has come down. I think, that over so many years, because there's been a drought of investment, we were anyway going to come out of it, and the budget has given us a push towards that direction.
Right. So Arvind, coming back to you, so are you worried, about, well, actually it's too early, we have to see the documents, but this move from 9.5 to 6.8, not very clear. I mean, on this overall the fiscal glide path, do you have any thoughts on that, and how they will even reach 4.5%? Especially if this, in this bid to be transparent, all the NSSF funding comes on the balance sheet now, the FCI funding.
I think you should assume that. She mentioned that in the speech that, they've taken off balance sheet to on balance sheet. So a bulk of the increase this year and estimated for next year is going to be this transition from, I think, mostly food subsidy. I think they're smart in that sense to show the actual amount of spending on food subsidy, given whatever is happening with farm loans and farm protests, right? So it's upfront, it'll be there. And we've been asking for a long time. It doesn't matter. For the markets, borrowing is borrowing, right? You borrow from this government, or you borrow from small savings, or you borrow from public sector. The markets kind of price it. So bulk of increase is kind of coming from that. I think if the growth picks up, and for us, for a long period of time, we've always maintained that India's potential GDP growth is about 6.5 to 7%, right? And we were thinking it has reduced to below 6% pre-COVID itself, and then COVID hit, and our issue has been that households bore the brunt, not only during COVID but prior to COVID also. If you take Manas's point of fixed capital formation, if you break through to that data, last 5-7 years, households investments, fixed investments have fallen. It's not that the corporates have cut down on their Capex. Corporates have been like a flat line. Household investments have come down, largely into dwellings and real estate, and also small businesses setting up their own investments. And I don't know whether that has still, and that would have got impacted even more during COVID, right? The lack of incomes, the lack of livelihood support. I mean, they've supported food and they supported some income, but they haven't supported loss of business income for small households. We still don't see it. So they're still betting on the fact that more investment spending will eventually lead to job creation, and that job creation will lead to growth, and then the growth will lead to household incomes. That's a long phase. We would have still liked some more cash outflow, just spending, just to beef up the balance sheets of the households, which also has multiplier, right? When households start investing in, say, houses, house building and house construction, it has a very significant multiplier, as against a public sector doing a multi-year, multi-decade investment project. So, that's the issue. I think the fiscal, in terms of whether they can come back to come down to 4.5, surely. I mean, if they could manage 3.5 a few years ago, and so this 6.5 to 4.5 should be managed. The key will be growth, right? And this new trend of asset monetization. Although the disinvestment number is actually lower than what was budgeted for the budget, like FY21 budget was 2 lakh crore and now it's 1.75 lakh crore. So we need to see details on whether there are asset monetization outside of the disinvestment budget. But if they kick it up and if they find foreign investments coming into roads and this transmission pipelines and for some land parcels, railway stock, then you would see they'll find it easier to consolidate and get the fiscal deficit lower. But even then, as I've been saying, this is a 4.5 for FY25 is a lot of leeway. There's huge room for spending, which should improve growth in the coming years.
Right. So, Manas, what are the risks associated with the budget? I mean, the divestment target is one. It never, multiple years, the successive governments have never been able to hit the target. But apart from that, what are the other risks you see of where things could go wrong?
So the first risk, I think, is the deficit, right? I mean, like it's high, but then we have to see how much of it is this increase is due to the off balance sheet items coming on balance sheet, right? So that and the actual deficit will come down. Right? The other thing is that of course, implementation is a big hassle, and we have to see how much of this is implemented. As Arvind pointed out, we don't know whether there's any data on this monetization pipeline. Yeah. So we really don't know. It's an expression of, but at least it's a good expression of intent. It's the first time they've said it, and they said there's a monetization pipeline. About the consumption thing, Arvind, I'd just like to tell you point out one particular thing. According to the CMI, the latest unemployment rate is lower than what it was 1 year back, and even in December 2019. So, the worry was that these small businesses and small guys in rural areas have got jacked because of the pandemic and other stuff. So, but that, I think, if the unemployment rate is now lower than what it was in January 2019, that automatically means that the rate of spending by households will also go up, will it not?
Okay, I was muted. Yeah, we tracked that data very, very closely. I think 2-3 things are happening. If you look at the employment rate itself and take it pre-COVID, it has gone below 40%. For a young country with young population, young people getting educated coming out, China in that similar period was closer to 60% employment rate. So our employment rate itself has gone down. CMI data, for people don't agree with it, I really love that data because it showed exactly what was supposed to happen. In March and April, people lost jobs and people went out of workforce. And as things came back, they're coming back into the system, and unemployment rate actually has fallen. But if you look at the underlying data of what has happened, you see a significant amount of people who were quoted as salaried workers have now become self-employed workers, and that is never a good sign. It is just that you haven't found the job and you found something else to do on your own, and you're going by. Those things are can have an impact over a long period of time. So that is a worrying sign that household income and balance sheet is still very, very weak. We should hope that this spending increase by the government and they've taken the fiscal conservatism completely out of the way, and wanting to spend and wanting to support the economy and grow the economy, kind of helps household balance sheets to also reshore. As you said, corporate balance sheets are much better. Government balance sheets here and there. Household balance sheets were weaker. If the spending impulse and goes into income and growth and then consumption, but it's a slower process. Right? We still think incomes were hurt way more than what it is going to be get supported.
Right. So because of that, we didn't see any significant changes to tax rates. But Gaurav, this 12 lakh crore gross borrowing number for a fiscal deficit of 6.5%. How do you square it? Do you think that tax buoyancy assumptions are much more than usual, for example?
I just want to make one small point about consumption. Actually, I don't agree with the fact that this budget doesn't really provide stimulus to consumption. Rural consumption, because of procurement and higher MSPs, will, I'm assuming a normal monsoon next year as well, will actually get a fairly significant flip. Remember, agricultural wages are already going up. Narega spend this year is 1.5 lakh crores. I would presume that some of you may have actually seen that increase even further. So I think there is a fair amount of push towards consumption. And remember, the multiplier of Capex is significantly higher than revenue spending. And I think households have in the first half of the year saved quite, savings went up. So that precautionary savings which they did will help smoothen out consumption. Financial conditions have clearly become far more easier than they were. Like an NBFC sector, which you could recall about a year or so back, is clearly is in a far better footing now. So credit conditions have also improved, and I think as the economy revives and sectors barring contact-intensive services, even where their normalization continues as we speak, I think my sense is there is enough support provided to consumption as well. And remember, last year the government actually put a clampdown on increase in government employee salaries and such. All that will be taken away this year, both by the center and state government. So this is, to me, I think rural push is very much there in the numbers. And on your question, I think ultimately what matters is the tax to GDP ratio is. I would presume, at my estimate, as I mentioned earlier, is that both tax and non-tax revenue collection is no more than 9% of GDP. So I would think that at 15% GDP growth, assuming a buoyancy of about one time, we don't have the numbers yet. So I presume the buoyancy assumptions are would be stable. They would not be very, very aggressive as we've seen in some years, and then we end up seeing a disappointment on that front. And remember, as the economy revives, last year I think a large part of the fiscal slippage was also on account of the tax shortfall, close to about 3%. Now, if that gets made up in the coming year, that itself brings you back to levels of tax revenue prior to COVID. But that said, on the whole, over a longer term period, we need to make more efforts to push our tax to GDP ratio, which compared to other emerging markets of similarly rated emerging markets is lower. Our public debt is higher. Yes, what works in our favor is that our nominal GDP growth continues to exceed the average interest cost on Government of India bond, barring this fiscal year where we've seen a contraction. And bond, as the economic survey has gone at length to explain that debt sustainability is essentially a function of that gap remaining negative. So I think I'm hopeful that they've not set themselves a very stiff target of 3%. I think 3% is a construct which came out of the European Union, that agreement which was formed. And there has been a significant change in the thinking of IMF and the World Bank itself throughout this year in terms of their policy conservatism when it comes to the fiscal front. I think that's getting reflected in the government focusing on spending and getting the economy back on ground, focusing on investment and healthcare. And implementation is always the key, as with anything else.
Yeah, isn't that the case for everything in India? Well, I believe Gaurav has to leave now. Thank you, Gaurav, for joining us. Thank you. We'll continue the discussion with Manas and Arvind. Manas, so there were expectations that there will be incentives or SOPs for some of the sectors which would be scarred heavily, the most, which was scarred most, like for example, tourism, or aviation, for example. But there was nothing much. What do you make of that? You think a
Yeah,
sector agnostic approach is the best way to go?
they could have done something for these sectors, I guess. We don't know. We have to see the fine print whether they have
Yeah.
done something or not. Part of this is covered under that credit guarantee schemes. Some SOPs have been given to these
Yeah.
sectors. Though I don't know whether that has been extended or not. That credit guarantee scheme, I presume it will be. Uh, about this fiscal deficit, there's just one thing I'd like to tell you guys. The IMF fiscal monitor says, and I'm quoting, Indian government debt is expected to remain elevated at 83% of GDP, highlighting the need for a credible medium term fiscal framework to enhance confidence, anchored on revised fiscal objectives and revenue mobilization. Arvind, what do you think of that? Do you think the rating agencies will now take a look askance at us?
Manas, I've always had a view that the Indian rating, and I've actually written about this, that the Indian rating is a rating for growth and not a rating for debt. So it's not that India is rated investment grade because we have high debt to GDP.
Yeah.
India is rated investment grade despite high debt to GDP because we have that ability to grow. So if anything, rating agencies should have been worried. I think Moody's downgrade was kind of a worry for that, saying that the potential growth is going down in India, and with the high debt to GDP and a low growth as compared to what was expected of India, India does not deserve to be a investment grade. So I actually made a statement saying that if the growth does not recover in the next 2 years, India might actually get downgraded to junk grade. So that growth is far more important. So that the denominator of nominal GDP, right? That was the view, right? The nominal GDP in India will grow at 12 to 13, 14%. And that will take care of your debt problems. India can outgrow our debt issues, and that's why you always had that glide path of debt to GDP coming down from 70 odd percent in the 90s, to almost 60. We kind of reached 60, and then we are going back again. This year, keep COVID away. If the increase in fiscal deficit, and I'm actually very, very surprised that Prime Minister Modi, took this charge, because in my naive view, I think the two macro data points that matters to Prime Minister Modi is inflation and fiscal deficit and debt. And that's one of the reasons he came into power in 2013. When Pranab Mukherjee in 2011-12 blew out the fiscals, and we had a big stimulus after the Lehman crisis, which is maybe not required in hindsight, right? And that had macro stability problems. And if you look at how they've performed over the last 4 years, there is no surprise that MSP prices increased by 3.9% because the CPI target is 4%. So if MSP increases by anything more than that, it gets difficult to reach that 4% CPI target, right? I mean, if you look at the first press release of GST was on the inflation impact of GST, a multi-generational tax reform based on a year-on-year increase in CPI. That's how kind of maniacal they were to ensure that inflation remains low. And the way they've managed the fiscal deficit, off balance sheet, on balance sheet, spending here, spending there, but they've managed to keep that headline number low. I thought they will continue like that. And even in this COVID year, where everybody was saying just blow out the fiscal, spend and get the growth back, they didn't. And it looked like it came from the PMO, right? They didn't want to increase the spending. But now that he's kind of bitten the bullet in terms of wanting to get growth back and increase in the fiscal deficit. If we get the growth, we'll get paid for it. If we do not get the growth, then we'll have a problem and then all this rating downgrade. It's a later on story, but we need to be careful about that. We need to get growth. If you're able to demonstrate that nominal GDP growth is going to get back to that 12-14%, real GDP growth will be upwards of 7%, we are good. Rating agencies, foreign investors will actually vote for that. So there's so much to like about this budget, and if you're able to get that growth with the increase in fiscal deficit, this will be a great 2, 3, 4 years going ahead.
Well, that's it, folks. That's a key takeaway from this panel. This is probably the best budget presented by Finance Minister Nirmala Sitharaman.
Absolutely.
The government has decided to focus, almost exclusively on growth, and they are willing to borrow and spend heavily to finance this growth. But on the flip side, if this growth does not materialize, it can cause macro stability problems. Yeah. Thanks for joining, Arvind Chari from Quantum Asset Managers and Manas Chakravarti. Thank you.